Good morning, everyone. We will get started in just a few moments. Good morning, everyone. We will get started in just a few moments. Good morning, everyone. Hello, and welcome to our Expat Tax Preparation webinar. Today, we're going to talk about the tax filing requirements for expats, as well as some of the most important issues you need to understand when preparing your tax return. We'll also talk about the benefits of working with a professional tax preparation company. So by the end of this webinar, you should understand your basic obligations as an expat, as well as some of the most common pitfalls and misconceptions. If you stick around until the end, we even have a special bonus for you. Finally, we will save a few minutes at the end of the presentation to answer your questions added into the Q&A box. If we run out of time to answer your specific question, we will reach out to you directly with an email response. Before we dive in, let's take a minute to talk about who I am and why my advice matters. My name is Randall Brody. I'm a licensed enrolled agent with over 25 years of experience helping U.S. expats stay compliant with the IRS. All members of our firm are either CPAs or enrolled agents. We specialize in expat taxes, and we know all the regulations inside and out. Not only have we helped thousands of expats prepare and file their tax returns successfully, but we also know all the ins and outs for dealing with back taxes and delinquent returns and compliance issues. So let's get started. We'll start with a simple but common question. Do expats really have to file a tax return? After all, you're living and working in another country, so why should the United States care about your income? Unfortunately, the U.S. is not like other countries when it comes to foreign sourced income. The U.S. tax filing requirements apply to worldwide income, so living abroad won't excuse you from filing or paying taxes to the IRS. In fact, if you're a U.S. citizen or resident, you are still subject to all the same filing requirements, even if you aren't living or working in the country at any time during the year. You may even need to file additional documents when you live abroad that aren't required for most taxpayers in the U.S., such as a report of your foreign bank holdings known as the FBAR. Although the U.S. requires most expats to file a return, that doesn't mean you'll owe a large tax bill when you're done. In fact, the IRS offers several tools expats can use to lower tax liability or even eliminate it altogether, especially if you've already paid taxes overseas. The first of these tools is the foreign earned income exclusion. If you qualify for this exclusion, you can exclude a large portion of the money you earned outside the U.S. from taxable income. For tax year 2019, the maximum foreign earned income exclusion is the lesser of the foreign income earned, or $105,900 per qualifying person. For tax year 2020, the maximum exclusion is increased to $107,600 per person. If two individuals are married and both work abroad and meet the bona fide residence test or the physical presence test, each one can choose the foreign earned income exclusion. Together, they can exclude as much as $215,200 for the 2020 tax year. Again, this number is adjusted every year for inflation. To qualify for the foreign earned income exclusion, you need to meet a few requirements. First, you must have your tax home in a foreign country. Your tax home is a place where you usually conduct business. It doesn't necessarily need to be your family's place of residence. Keep in mind that the IRS will not consider you to have a tax home in a foreign country if you are maintaining an abode in the US, even if all of your money comes from foreign sources. In addition to having a tax home in a foreign country, you must also pass either the physical presence test or the bona fide residence test. To pass the physical presence test, you must be physically present in a foreign country for at least 330 days in a period of 12 months. These 12 months must be consecutive, and the period can start or end during the tax year in question. The 12-month period you use to satisfy the requirements of this test must also contain at least 365 days. For this test, the IRS defines a day as a period of 24 hours that begins at midnight. If you travel in and out of the United States during the year, keeping careful track of travel time and time spent inside a foreign country and the US is essential. To pass the bona fide residence test, you must be able to show that you are a bona fide resident of a foreign country for the entire tax year. This may sound simple, but it's important to note that simply living inside another country during the tax year won't automatically make you a bona fide resident. To be a bona fide resident, you have to prove that you not only do you live in another country, but that you have established a residence you intend to keep for an extended period. The bona fide residence test becomes more complicated when certain tax treaties are involved or when you've made certain statements to foreign governments. So it's best to talk to an expert if you're hoping to use this test to claim the foreign earned income exclusion. The IRS ultimately will decide whether taxpayers pass this test on a case-by-case basis. If you satisfy the requirements for the foreign earned income exclusion, you can use it to exclude wages or self-employment income you earned for work you did outside the US. Although you can include commissions or bonuses, you can't include self-employment taxes, which are Social Security and Medicare taxes paid based on net income from self-employment, nor can you include income earned as a government employee or passive income, such as interest and dividends. Another tool available to help you reduce U.S. taxable income as an expat is the foreign housing exclusion and deduction. The foreign housing exclusion and deduction can be used to deduct any qualifying housing expenses you paid from self-employment income, or to exclude any housing expenses paid from funds provided by your employer. Your housing amounts are calculated by your total housing expenses less a base housing amount. Qualifying housing expenses include things like rent, repairs, utilities, insurance, rental furniture, and parking costs. Certain lavish expenses, such as the cost of maid service, can't be included as qualified housing expenses. Keep in mind that there are specific limitations on this tax benefit, and the calculations can be complex. It's also important to note that you can't double dip when you're claiming the foreign housing exclusion and deduction. Housing expenses paid with income you've already excluded can't be deducted or excluded a second time. To claim the foreign earned income exclusion and the foreign housing exclusion and deduction, you must submit Form 2555 to the IRS. If you're a calendar year filer, this form will be due on April 15th with your annual tax return. If you're living in a foreign country on the normal April 15th tax deadline, you're automatically granted a 2-month extension on the deadline for this form. Let's move on to the foreign tax credit, which is another excellent tax benefit available to expats. The foreign tax credit is designed to reduce the burden of double taxation, which would occur if you paid taxes on the same income to both the US and a foreign country. If you qualify for this, you can directly reduce your US tax liability dollar for dollar by the amount of income tax you paid to a foreign country. The foreign tax credit is available to individuals, estates, and trusts that paid qualifying taxes to a foreign country or possession. The credit isn't available to non-resident aliens in most cases. In general, only income taxes paid on foreign source income will count towards this credit. Foreign source income includes compensation for services performed in a foreign country, foreign interest income, and foreign corporation dividends. To be considered a qualifying tax for this credit, the foreign taxes you paid must be legal and actual, which means that you legally owed them and must actually have paid them. If you could have been exempted from the tax, it can't be used to claim this credit. Qualifying foreign tax credits, qualifying foreign taxes must also be imposed directly on you. You must be able to show that you have already paid them or will have paid them. Finally, these foreign taxes must be income taxes. If you ultimately receive a refund for taxes you used to claim the foreign tax credit, you'll need to amend your U.S. tax return. Certain taxes are specifically excluded from this credit, including refundable taxes, taxes that could have been legally avoided, and taxes paid to governments not recognized by the U.S. Likewise, you can't claim any taxes paid to governments the U.S. has designated as supporters of terrorism. You must usually file Form 1116 to claim the foreign tax credit. However, you may be able to claim the credit without this form if you meet certain requirements. Keep in mind, the credit without filing Form 1116 prevents you from being able to carry forward or carry back excess foreign taxes. You can't claim both the foreign earned income exclusion and the foreign tax credit on the same income. As a result, many taxpayers have to choose between taking one or the other. Depending on your unique situation, one option may be better than the other. In some cases, it may also be possible to split income between the exclusion and the foreign tax credit. If no foreign taxes were paid, it's an easy choice. However, if you did pay foreign taxes, the situation is more complicated. An expat tax expert can help you decide which option is best for you based on your unique situation. Even after you have applied the exclusion and credits available exclusively to expats, you may still have taxable income. If this is the case, you may be able to use other credits and deductions to lower your bill even more. Expats have access to many of the same standard benefits available to taxpayers living in the U.S., such as deductions for mortgage interest and state income taxes paid. Foreign property taxes are no longer deductible on Schedule A. Be sure to take advantage of these benefits to minimize your U.S. tax liability as much as possible. Income tax is not the only U.S. tax you may need to consider as an expat. If you are self-employed and working in a foreign country, you are still subject to U.S. Social Security and Medicare taxes. Unfortunately, many foreign countries collect their own version of Social Security taxes, leading to double taxation for many expats. None of the tax benefits we've discussed so far can be used to eliminate this obligation. However, relief may be available if you're earning income in a country that has a totalization agreement with the U.S. These agreements eliminate dual Social Security taxation, allowing you to pay Social Security taxes to only one country. These agreements aren't available in every country, and where available, a certificate of coverage from the foreign country must be attached to your federal tax return. So it's important to do your homework. Just as being an expat doesn't exempt you from income tax filing requirements or Social Security tax, it doesn't exempt you from gift tax either. As for U.S. residents, you can make unlimited tax-free gifts to a U.S. citizen spouse. However, if your spouse isn't a U.S. citizen, a special threshold may apply. For all other people, you will need to report gifts that exceed a certain threshold during the year. For 2020, the threshold is $15,000. Most taxpayers will be able to use their lifetime gift tax exemption to avoid paying taxes, but you will need to file a gift tax return still. Estate taxes may apply to expats as well, and these taxes will be based on your worldwide assets. The IRS allows an exemption and estates with combined gross assets and prior taxable gifts over a specified amount. Above this amount, it may be subject to taxation. Taxes are levied on the estate and not the people who inherit. Many people mistakenly believe that moving out of the country eliminates all state tax obligations. Unfortunately, this isn't always the case. If you're still considered a resident of certain U.S. states, you may owe taxes to that state even when you live outside the U.S. for the entire tax year. To avoid issues with state taxes, it's important to learn about the laws in the state you moved from. Each state has different residency rules that apply to taxation. Failing to file a required tax return and/or pay state taxes you owe can lead to penalties. Before we move on to other IRS requirements for expats, let's take a moment to talk about the importance of filing a tax return. Many expats who don't owe tax to the U.S. will still need to file an income tax return. Failing to file a required return can lead to penalties. Because these penalties can be serious and you may lose out on valuable tax benefits such as the exclusion, ignoring the obligation to file a return is never a good idea. So be sure to file on time every year, regardless of your expected tax bill. Filing tax returns isn't the only responsibility you have as an expat. You may need to file information disclosures to the IRS as well. One of the most common disclosures required is the FBAR. The FBAR stands for Foreign Bank Account Report, which is also known by its form, FinCEN Form 114. This form is required by the IRS to aid the U.S. government in determining if a U.S. taxpayer is evading U.S. income tax. The FBAR requires you to list all your foreign financial accounts, including bank accounts, mutual funds, brokerage accounts, and more. Another common international disclosure is the Form 8621, which is generally required whenever you invest in a foreign mutual fund. The U.S. classifies such investments as PFECs, otherwise known as passive foreign investment companies, and as such are subject to very punitive and costly tax disclosure requirements, along with very high tax rates. An FBAR may not be required for every taxpayer who has assets overseas. However, if you are a U.S. citizen or U.S. resident with significant financial interests abroad, you probably need to file this form. Specifically, you must file the FBAR if you have a financial interest in or any signing authority over foreign accounts with an aggregate value of more than $10,000 at any time during the year. Foreign accounts include any account held at an institution outside the U.S. Keep in mind that you must file this form even if you have only signature authority over a foreign account. Likewise, even if the account produced no taxable income, its balance still counts for the purpose of FBAR filing requirements. Keep in mind also that the filing threshold for the FBAR is based on the aggregate balance, not the individual balances of each account. Even if none of your accounts has a balance over $10,000 during the tax year, you'll still need to file this form if the total of all account balances were higher than the threshold at any point in time during the year. Because the FBAR is only a report, it's common for expat taxpayers to view it as no big deal. However, this is not an IRS requirement you can afford to ignore. If you don't file a required FBAR, you may face fines and penalties with the IRS. Failing to file an FBAR can even lead to criminal charges. It is also a deceptively easy form to complete in that it is an easy form to fill out, but easy to make costly reporting errors and omissions by not knowing what needs to be reported and how. You may think that you can fly under the radar with this requirement, but the IRS will know if you don't file. Foreign financial institutions are required to collect and report certain information about accounts owned by U.S. taxpayers, giving the IRS everything it needs to discover your unfiled FBARs. Like your tax return, FBARs must typically be filed by April 15th. However, the last couple years, an automatic extension until October 15th has been granted for those who missed the April 15th due date. You must file this form every year your foreign accounts meet this threshold. Another form some U.S. expats must file is Form 5471, which applies to U.S. persons who are officers, directors, or shareholders in certain foreign corporations. This form reports the activity of the foreign corporation to the IRS. Like most international disclosures, it carries the potential for hefty fines if not filed on time or accurately. If a certain threshold is met, you need to file the Form 8938, the Statement of Specified Foreign Interest as well. For a single U.S. resident, that threshold is $50,000 on the last day of the tax year or $75,000 at any time during the year. For a couple that is married filing jointly, it's $100,000 at the year end or $150,000 at any time. For single taxpayers residing abroad, the threshold jumps to $200,000 for year end and $300,000 at any time. While taxpayers filing jointly and residing abroad must meet the threshold if total foreign specified assets exceed $400,000 on the last day of the tax year or $600,000 at any time during the year. Keeping up with all the IRS filing and tax payment obligations is essential for all expats. Unfortunately, many expats simply aren't aware of the IRS filing requirements, and as a result, may have multiple unfiled returns and or back taxes, or even incomplete or missing disclosures. If this is the case for you, you may need to move quickly to minimize the consequences. The longer you leave the situation unresolved, the more likely you will be to face harsh penalties. The first step usually involves filing all the returns you missed and coming into full compliance. You also need to take steps to resolve any tax debts you owe as applicable. Fortunately, the IRS offers several options for taxpayers who want to resolve outstanding debts. At Tax Samaritan, we specialize in helping expats with all of their U.S. tax needs, from filing returns to resolving unpaid tax debts. If you have unfiled returns or international disclosures, we can help you deal with these issues quickly as well. Please contact us to learn more about our services. If you're ready to move forward, respond to the email that we will be sending very soon. If you're not quite ready to take that initial step, we can offer a private, no obligation chat with you. Just call or email us, and we'll be happy to start helping you. If you would like to receive a complimentary copy of our Expat Tax ebook, Tax Samaritan's Indispensable Guide to How U.S. Taxpayers Abroad Can Save on Their Taxes and Keep the IRS and state tax authorities happy. Wow, that's a mouthful. Please visit us at the link that you see there on the page. At this time, I'd like to turn it over to any questions that you may have. Please feel free to enter them into the Q&A box, and I'll be happy to respond to you. And we'll give it a minute to see if there are any questions. This is very unusual. Normally there are a lot of questions, so don't be shy. Feel free to ask any questions or concerns that you have. Of course, if you feel that you'd like to do it privately, please feel free to email us at help@taxsamaritan.com. First question is, my only income is Social Security. How does that apply? If your only worldwide income is Social Security, then you would not have an individual tax return filing requirement. However, other information disclosures may apply, such as the FBAR or the Form 5471 that we discussed. So if you do have foreign accounts over the threshold, that reporting requirement may apply, even though you may not have an individual return filing requirement. Next question is, what if you haven't filed for many years? I'm not sure what the specific question is. You know, obviously, the recommendation is that you get caught up with those filings and back into compliance. While there is no statute of limitations for unfiled returns, you know, in theory, the IRS can go back indefinitely, but in practice, in most situations, unless there is a pre-existing condition already with the IRS, the normal expectation from the IRS is to file the prior 6 years of returns. If you have unfiled FBARs, the statute of limitations is 6 years on that. So it's not unlimited on FBARs. Next question is, if you move to a foreign country mid-year, can you claim the exclusion for the whole year as a foreign resident? No, you would need to qualify under the physical presence test. If you qualify under the physical presence test, your foreign earned income exclusion, your cap on the foreign earned income exclusion would be prorated based on the number of days within your qualifying period for the exclusion that falls within the tax year. So it would not be possible to qualify for the whole year, nor would you be eligible to qualify as a bona fide resident. To qualify as a bona fide resident, you must reside at least a minimum of 1 full calendar year in the foreign country. I have a next question is, I have a property I bought and want to flip. When I sell it, what happens with the profit I received? Capital gains, it's treated as capital gains and reported on your U.S. Tax return. It's treated as investment income, specifically as capital gains. If it's a U.S. property, of course, you pay full U.S. taxes. If it's a foreign property and you're paying foreign income taxes on that sale as well, you may be able to utilize the foreign tax credit to offset your U.S. taxes. What about if a Canadian bank offers that they have QEF mutual funds and that they will provide all the data needed for the Form 8621? Is it then less complicated, or should one still avoid all such foreign mutual funds? So yes, you would still have a Form 8621 filing requirement. So you still have a high cost of compliance. The tax treatment is a little bit more favorable with the QEF versus the default treatment for a PFIC absent a QEF or other election. But still, in comparison to how it's treated versus US-based mutual funds, it's still unfavorable. So it's something that you would want to explore very closely to determine whether the trade-off and potential additional investment income versus the cost of compliance and taxes is worthwhile. All right. Question is about state taxes, specifically New Jersey. Do I need to file state taxes as I have no ties to New Jersey anymore? We can respond to you offline about that. Each state has specific filing obligations, uh, uh, whether you're continued to be treated as a resident or not. And we can respond to you about New Jersey in general terms. What is the best way to maintain my last state residency as an expat? So I'm not sure if the question is, and you could clarify if you'd like, whether you're desiring to maintain that state residency, or if you're trying to change your residency or try to be treated as a non-resident. There's two different routes that we could take on the answer to that question. Very different, but feel free to clarify if you'd like. You would like to maintain the last state residency. So to maintain, each state has its own rules for maintaining residency. Certainly, if you want to maintain the state residency, you would continue to file state tax returns for that state, maintain your voter's registration, driver's license, etc., with that state. Oftentimes, that's not the case. Most taxpayers, particularly if they're looking at a state income tax obligation, do not wish to maintain that residency. So if you're in a state such as South Dakota with no state income taxes, then that is not an issue, of course. So to maintain the residency, of course, maintain your driver's license and voter's registration, and there are specific rules that they consider to maintain your residency. Each state is different. All right. Wait and see if there's any additional questions. Question, did we just hear that Social Security doesn't need to be reported? Pensions, that's not the information I have. No, that's not at all what I said. If your sole worldwide income is Social Security, if that is your only income worldwide, then you do not have a tax filing requirement. If you have a tax filing requirement, absolutely you have to report your Social Security. Likewise, pensions always have to be reported. There are specific rules and very complex rules depending on what type of pension you have. If it's a US-based pension, it's a bit more straightforward, of course. But if it's any sort of foreign pension, oftentimes it can be very, very complicated. And that's another area of unique disclosures and tax treatments, if that applies. If you have any sort of foreign pension or private pensions outside of the US. Next question is about pricing. If you'd like a quote, if you visit our website, taxsamaritan.com, in the upper right-hand corner, you'll see a red button that says Get a Quote Now. If you just click on there, and under tax services needed, just add a check mark for tax preparation. It's going to ask you a few specific questions about your situation so that we can provide a very detailed quote for you, not just the fee, but also what forms will be needed for your filing. And we'll also send along some additional links to additional information about those forms, things that we think are important to know and educate yourself about. Next question is, if you take IRA distributions, will you need to file taxes? Yes, if you meet the filing threshold to file an individual tax return, absolutely, you'll need to report those distributions on your return, and there may be taxes due at that time, depending on what your gross income for the year was on all of your worldwide income. So absolutely, in most situations, depending on the amount that's distributed, it would trigger a filing requirement. Okay, we'll see if there's any other questions that come through. I'll leave the webinar open for a few more moments. See if you have other questions. Again, you see the link there for the expat guide. I have the guide goes into much more detail. Apologize if it's too much detail. I tend to go a bit overboard at times, but my preference is to provide too much information and not enough. And then you can decide from there, you know, what's important for you to review. I think you'll find that guide to be very helpful. Feel free to request that. That is a free download. Again, if you have other questions, feel free to email us at help@taxsamaritan.com, or you can call us anytime at 702-350-1040. I'd like to thank you for your time, and I hope you have a wonderful rest of the day, evening, or morning, wherever you happen to be in the world currently. Thank you.